Kevin, as always, great to see you. Talk us through your hypothesis here. What was it? Predictability, flexibility, durability? I can't even remember.
I like your lead-in. Yeah. So as we come into the year, we're seeing some change in the market and the macro data. We just published a piece called "How Things Are Changing" on our website at WashingtonCrossingAdvisors.com. But the essence of it is that we're seeing a more mixed churn underneath the market. We're starting to see some of the signs of economic growth looking fairly peaky. So the PMIs, for example, or investment as evidenced by capital goods orders, those things look very strong, but they seem positioned to roll over. And of course, we've got policy supports that are looking to be pulled away as a result of rising inflation and rising debt. So all of that to us signals that things are starting to change. And in that kind of environment, you want to own companies with very strong balance sheets, very low debt, very consistent cash flows, very profitable assets, so that you can have a flexible portfolio. So if and when the chips are ever down, we're able to weather that storm fairly well.
Well, speaking of chips, as our producer Maria Bowden pointed out, your three stocks all have chips in them: potato, chocolate, and silicon. Hershey, Intel, and Pepsi. Let's start with Intel, which is a kind of unloved stock.
Yeah, very much. Intel is as the dominant leader of producing semiconductors, chips for computers. They are at a critical stage in their evolution where they're making some very, very large investments in the heartland of America to produce semiconductor chips at scale in the United States. And the way that Intel is typically most successful is being an innovation leader, but also being the producer with the lowest marginal cost. And on the other side of this, our bet would be that Intel will again be successful at scaling up as they have in the past with these investments. And on the other side, you could have a very formidable competitor. So yes, it's unloved, but it's a company that we think has a bright future and is going to be successful on the other side of this chip shortage.
Yeah, so the reports of its demise greatly exaggerated. It is not, the time has not passed it by. Quick thoughts on Hershey chocolate chips and Pepsi potato chips.
Yeah, both of them very, very consistent. And we think that ultimately they have some pricing, there's cost issues in the present time as everybody's confronted with cost issues. But I think these companies are getting out ahead of that with having the right products in the right places. Obviously, we're thinking that as we go forward, they're going to be able to pass along a lot of the cost increases that they're currently experiencing like everybody else. And in the end, they both have a very, very consistent business, and they're growing their dividend very nicely with an excellent balance sheet, both of them. So we like both of those stocks as core holdings in a portfolio.
Kevin Caron, thank you very much. Washington Crossing Advisors.
Shepard Smith here. Thanks for watching CNBC on YouTube.